Hey guys, it's the Unicorn of Wall Street and welcome to my channel. Here we talk about trading, crypto, strategies, and almost anything that crosses my mind. Okay, let's get started. Okay, so today I wanted to talk about specifically Mr. Jeremy R. Russell. His Instagram is, I think, at 20-Minute Trader. I know this is his website and he has roughly 400,000 followers. And I don't want to be those ones that do video. I'm nothing but love, trust me. And I really have nothing against Mr. Russell. I think he's a brilliant trader. Surely he's profitable, and that's great. But for whatever reason, I keep on getting his ads and his newsletter, and he pops up on my Instagram. And there's really no envy, even if I have 4 followers. It's, as I said, nothing but love, especially for traders who are profitable. But I took a look at his, not specifically his strategy, but kind of his claims and what he's doing. And I think that I've seen these type of courses and whatever it is, it's signals or it's an indicator, whatever it is. I've seen them so many times, and there are some details that often aren't discussed. There's some mathematical principles that are behind, let's call it an intrinsic failure of these systems. And I'm not calling in any way or shape or form Mr. Russell a scammer. I'm not judging his abilities. I'm not judging in any shape or form what he's doing. Again, do your own research on his material. I'm just taking him as an example to kind of prove something that I think people out there who are interested in trading, who are getting they're getting involved with trading. I think you should really consider the math behind and the statistics behind the chances of you succeeding or failing with a system. And as I said, that's whatever system, not this specific system. Even a system that can be brilliantly profitable and successful can turn against you. And many times people say, it's market conditions, this is that. No. And today I want to prove to you mathematically why that is the case. So basically, taking this example of the 20-minute trader, at the moment, Mr. Russell is every day posting his results to turn, I think it's like 200,000 into 1 million, which is great and it's brilliant. And I wish him the highest success. But if we then break that down and do the math, if people actually start doing the same thing, you'll see something very interesting. And this goes for any indicator. So the point is that what is a market? Well, a market is the supply and demand, right? So in this case, I'm just writing on top of Apple chart, right? So Apple has stock, people are demanding it, the price goes up. People aren't demanding it, the price goes down. Now, let's forget for a moment that we're talking about stock. We could be talking about apples or iPhones or cars or whatever, Let's talk about physical apples. You go to the supermarket and one apple costs, let's say, $1, right? If everybody wants those apples and there are only 10 apples, then it's like the Starbucks crazy stuff about the cups or whatever. They're a limited supply, price goes up. That's the principle of the anti-inflation of Bitcoin. Now, if there are, let's say, 100 apples and nobody wants them, they're going to rot. And so the supermarket might say, well, don't give me $1, give me 50 cents, or give me 40 cents, or give me 20 cents, and the price goes down. So that's how basic markets work, right? And that's exactly the same principle that we see every day in charts. Now, the interesting thing here is that let's say that if I understand correctly, what Mr. Russell offers in his 20-minute trader course is that he recognizes patterns, whether it's correlation between indexes like the US 30 or the US 100, 200, 500, whatever it is, it's irrelevant. He finds patterns that he probably found over years and years of looking at markets and trading markets, and he sees these recurring patterns, and there's a statistic that probably says every time that this happens, it will either go up or it will go down, right? And that's the principle of, well, in this case, let's call it technical statistical analysis. So what happens is that, let's do this extreme example. Let's say that Mr. Russell has a pattern that is so absolutely fantastic and brilliant and perfect that every time that pattern happens, 100% of the time the market will do what he predicts. Now, to simplify even more this idea, let's imagine that he prints, let's say on a daily basis or whatever it is, a nice big arrow, right? So market opens, he prints on the charts for his people a nice big arrow. It's green, it can be red, whatever it is, great. Okay, so at that point, people are looking, they see the arrow, they buy or they sell. Now, the idea behind that is that anytime you click the button and you're buying Apple or you're selling Apple, there's actually somebody on the other side filling your order. Now, it can be your broker or whatever, and I'm not going to go into how market makers work and all that stuff. That's a whole other chapter. But the principle is that for somebody who's buying, there's somebody who's willing to sell. Because if I have an apple, somebody comes up to me and says, "Hey, buddy, I'll give you $1," and I'll give him the apple, right? Now, here's the principle. If everybody's looking at Mr. Russell's arrows, right? And they know that when there's a green arrow, the market will go up 100%. It's guaranteed the market will go up. Well, at that point, once I push my button because I see the green arrow, there will be nobody on the other side willing to sell. Because everybody's like, well, okay, Apple is what, 187 now. I have an absolute certainty that it's going to go up. So why would I sell something at 187 if I know for a fact that it's going to be 190 or it's going to be 195? I'm not going to leave just money on the table for that. So a strategy, if it becomes so known to everybody, it won't work anymore. And that is the whole principle of any type of indicator, whether it's moving averages, whether it's now there's this whole ICT concepts and smart money and whatever it is, it is proportional to how its success is. Because the more people recognize a pattern and want to do the same thing, the less people, on the other hand, will be willing to fill that position. And the principle behind this is that everyone in the market, every person looking at the same chart, thinks that they know something that the other person doesn't. So when you are buying, you think that you know that the market will go up, and somebody at the same time is selling and is absolutely sure that the market is going down. And that's the same principle of why, for example, support and resistance don't work like a clock, because one can say, okay, this is resistance, right? This is support. Now the price goes down. Everybody can see that this is support and everybody can see that this is resistance. But everybody then will try to outthink the other person, right? Oh no, but maybe I can wait for a breakout and then I'll do, and then you start playing this mental game against other traders, and everybody thinks that their strategy is the best because, well, if not, you shouldn't be trading, that's for sure. And so the idea is that the more these indicators or trading courses or whatever, the more they are successful, the sooner they will die off, right? Because it will get to a point where there won't be enough volume to make things happen. And I want to dive into just the last thing and finish off this with a mathematical calculation for you to think about to understand your actual probability of making money with these type of systems. Mr. Russell has 396,000 followers on Instagram, and again, not in any position to judge whether they are 100% legit or they're not. I don't know. I have 4 followers, so and I don't even know them. So let's say, for example, let's round it out to 400,000, right? Let's say that 200,000, so half of his followers, which theoretically are people who are interested in what he says, and I follow him because I'm interested in what he says. I think there's value there. Let's say that half of them, so 200,000, actually buy his 20-minute trader course, right? What he's posting on Instagram is that I see a bunch of times that he's making, let's say $1,000 per day with his trading using his strategy, right? So assuming that his course explains to you exactly how to replicate the same things that he does, that means that 200,000 people that have bought his course will do the same thing that Mr. Russell does. That means that, for example, if there's a setup on Apple stock and 200,000 people, traders, are at their chart and they all buy simultaneously because they followed the rules, they checked all the checklist or whatever, and it's a buy. Everybody goes, buys. 200,000 amazing students, there you go, right? And let's do the math. If all those 200,000 make $1,000 profit, that means that they are extracting from Apple stock, so from the market effectively, $200 million on a daily basis, right? Now, the volume, for example, yesterday's volume, I think it was 68 million for Apple. And on average, I think it's like 56 million. So effectively, that's almost 4 times the average volume that is traded on Apple in one day. So you understand that the market is not even capable of absorbing that type of volume. So what happens is that actually these courses for sure show the success of a single trader and how he profits from it. But I'm sure that Mr. Russell doesn't want 200,000 people. Well, probably for the price it is, 200,000 is probably a lot of money. But if 200,000 people start doing exactly what he does, he'll probably dry up the liquidity of the market. And at that point, his patterns will be ruined because they're not based anymore on the same statistics as they had before. And that is for any trading strategy. Every trading strategy is successful and at the same time non-successful. So instead of keeping on looking for another indicator, another, whether it's volume profile, whether it's a magical, Bollinger Band or channel or pattern or whatever it is, keep in mind that everybody that looks at the same pattern will have a different idea on it. And so it's actually the mentality and the psychology of traders who look at that signal. And for example, the moment trading will become artificial intelligence, and artificial intelligence makes the same decisions based on the variables that it's given, the markets will become so efficient that they won't move anymore, because the movement of the market is based upon the fact that there are people who have different points of view. There are people that today will look at Apple and think up, people will think down, and people will think, no, I'm going to stay out. And we need that conflict of opinions to keep the market liquid, because the moment everybody does the same identical thing, then there won't be anybody else on the other side willing to take the losing side of the position. And that's why always keep this math in mind before you just randomly jump into these courses, because none of these courses will make you profitable. They will teach you how to develop your own pattern, your own strategy, your own way of looking at markets. But find your own way, find your little niche, and once you do that, keep it for yourself. Become profitable and live a great lifestyle. This is my suggestion, and the mathematics back me up. So, max respect, Mr. Russell. You're a cool guy, but maybe it's worth disclosing this stuff to your students. All right, till the next time, take care. Okay guys, thanks for watching. Please do consider subscribing to the channel, as it reminds Google that I do exist. Till next time, stay safe and follow the rainbow.